AMC just reported, this is the hype stock, the Wall Street bets, the whole thing. They were expected to lose 19 cents per share. They lost 20 cents per share. They're expected to do 1.16 billion in revenue. They beat with 1.17 billion in revenue. So, Seth, let's go to our software here and see how AMC is doing after hours, because we have live. No, oh my God, they're down 4%.
Oh my gosh.
So, Seth, let's talk about this for a second.
I don't get it, Paul. This is why investing's hard.
So, they missed by 1 penny per share. How many shares outstanding do they have? So let's go to the income statement and go all the way to the bottom. They have 515 million shares outstanding. They missed by 1 penny. So 515 million times 1 penny is, call it $5 million. Seth, how many theaters do they have?
1,000 theaters, Paul.
1,000 theaters.
Oh my God.
So they missed by $5,000 in revenue per theater. That's over 3 months. That's $1,666 per theater divided by 30 days. They missed by about $55 per theater per day
or two
in terms of
or 2 large popcorns.
In terms of profit. So guys, the company is now down, and I'm not saying it's not right. I'm not saying where this company should be, but I just did the math, and we talked about $55. They missed by 1 penny per share. When you work all the way backwards in 30 days in a month, they missed by $55 per theater in profit per day. $55. And they're down 4%. This should tell you that Mr. Market is irrational. This should tell you exactly what I talk about all the time when I say, guys, yes, they missed. And by the way, in no way, shape, or form am I endorsing AMC as a good investment. All I'm sitting there saying is take out all the BS and just focus on this number. Keep in mind, by the way, hours before they announced, expectations were 27 cents per share in loss. And then it got adjusted a much lower number. I don't know how. It all depends on where you're looking. The same Twitter account that we go to for the expectations changed within 2 hours.
It went down to 23, then 19, Paul, which shocked.
So I look at this going, do you not see the confusion I have? $55 per theater per day in profit for the entire quarter. And they beat on revenue by $10 million, which is $110 per theater per day in revenue. Right? So I look at that going, guys, how can anybody with a sober mind look at me and say that the market is rational and the market is efficient?
What does that mean to me?
To you as an investor, it means that you're going to take advantage of those situations. I don't mean AMC. AMC is a company that has struggled, right? It's theaters. Personally, I love going to theaters. Seth, do you go to theater?
Absolutely. I get the popcorn bucket. My wife's there.
Great. It's so great.
So one time I'm like, get me the big popcorn bucket because I'm going to eat all
this. You put the hole in the bottom.
Put the M&Ms in. I do M&Ms and popcorn, you know.
Do you really?
Keep going, though. AMC.
So what we do is we take the popcorn, we tell them to fill it up halfway, put the butter in it, then fill up the popcorn the other half and put the butter in it. That way we have great popcorn. They have the Coke Zero. It's a wonderful experience. But I get it. People want to stay home. People want to be there. I get that. But look at their revenue over the last 10 years.
They did have one of the biggest movies of all time come out, this Maverick Top Gun movie.
Oh, phenomenal.
Phenomenal movie. So,
and their revenue fell big time in 2021, in the previous year of 2021. Why? Because of COVID. But it was doing $5 billion in revenue. They did 1.16 last quarter. Extrapolate that out, that equals almost $4.5 billion, actually over $4.5 billion for the year. So they're making their way back. Okay, there are still concerns, blah, blah, blah. They're making their way back. The question you have to ask yourself is, from a long-term perspective, is the theater still going to be a place people go to? I still, call me old school. I'm not saying that it'll be as prevalent. 30 years ago, the only time you saw a new movie was in the theater.
Absolutely.
That is absolutely changing. But do you think it's all going to go away? I don't know. But let's go look at this company. Let's look at the 8 pillars of the company. So if you're new to this channel, I'm Paul. I'm a value investor. What does that mean? That means I'm not going to go buy hype. I'm going to avoid all the hype, and I'm going to look for companies that are being ignored by the market for whatever reason. They're boring, they're not exciting, etc. And I want to buy them for very cheap levels because I believe in the short run, stocks are a voting machine, and in the long run, they're a weighing machine. And I use my 8-pillar process to screen out companies. This is our 8 pillars on AMC. Seth, do you notice anything here?
That looks pretty ugly.
It's all X's. Does that mean don't buy it?
I mean, no, of course not.
Nothing is always, except it's a matter of the story. Is there a story as to why all these X's exist? There is a story. COVID happened. They're probably still recovering from COVID, right?
But this is very famous meme stock, Paul. And
very famous meme stock.
I'm guessing there are some viewers out there that got in and out of this stock not even knowing why.
So let's look at the 5-year chart of this thing. Oh, my lordy. How high did it get, Seth?
I didn't follow it, but I was just laughing.
$65?
There are still people with diamond hands, Paul, saying this is going to go again.
So AMC, let's see here. They hit a low right at the beginning of 2021 of $2 a share. Then they skyrocketed, and now they're at $18 a share. So right here on our pillars, everything is bad. 5-year PE doesn't exist because they haven't had any earnings in the last 5 years total. 5-year price to free cash flow doesn't exist, same reason. Cash flow is down, obviously, because it was pre-COVID, after COVID. Everything is bad. Everything is just bad. They issued a ton of shares. Now, you see this, Seth, but why did they issue 325% more shares? Because all these morons who were buying the company, AMC was just like, do you see how stupid these people are? If we give them crack, they're going to buy it.
Yes.
Let's give them more crack. They issued more shares. Why should they issue debt to the company when they can issue shares to people who just want to own it because of this stupid surge? I don't blame them. But you got to remember, that's going to affect the value. How much? Well, let's look at it this way. Let's say the company had 10 shares outstanding.
Oh, God, Paul, this is going to be astounding because they increased by 325%.
And they made $10 a year.
Oh, boy.
That is $1 per share in profit. Now, if they go up 325%, Seth, what does that take that 10 to?
I have no clue. You know, you're the math guy.
Okay, it takes it to 42.5 shares outstanding. Let's call it 40 just to be conservative. For those of you who think I'm wrong, 10 to 20 is 100%, 20 to 30 is 200%, 30 to 40 is 300%. This is not 400%, a very common math mistake. I understand why.
Math is hard.
But math is hard. So now they have 40 shares, essentially 40 owners to now give money to. Guess what? Let's say they make $10 again.
Oh, boy.
Now you split the $10 into 40 shares, 25 cents a share. So the company overall made the same amount of money, but as a shareholder now, you got 1/4 the profit. That's how bad that is. And all the company did was say, everybody wants our stock. Let's just give it to them. And if it crashes, we still keep the cash. The stock is worth less. No skin off our back. That's all they did there. So I want you, if this makes sense to you and you go, holy cow, I never thought of that before, subscribe to the channel because this is what we talk about every single day. In full disclosure, this is not exciting. You're not going to come in here and buy the most hyped up stock in the world. I'm not going to tell you to go YOLO on Coinbase or something stupid like that. What I'm going to sit there and say is your job is to buy as much cash flow as you can or earnings for as little money as possible. And your job is to look at the market and say, people are being crazy here. Here's where I'm going to be smart. Look at AMC after hours. It's still down 4%. Has it been halted or has it hit refresh? Oh my God, it's down 5.5%, Sethy. It's down 5.5%. Tim wasn't in here. It's down 5.5% because they missed profit by $55 per day per store and beat revenue by $110 per day per store. Do you hear this?
Yes.
Tim just said, "What? We just did the math." Guys, this is now, I'm not saying I'd buy this company right here. But what I'm going to do now is I'm going to go to Stock Analyzer tool. Even though AMC has had a lot of hard times lately, it's $4.5 billion in revenue annualized right now, which is pretty close to where they were beforehand. So let's go do some assumptions and see where we buy AMC at.
If you're following along at home and these ticker symbols and prices don't make any sense, we use the Stock Analyzer tool to translate these financials into a price you might want to be looking at to buy this stock. This is hard for me, Paul, at first.
So revenue growth. Obviously, these numbers are insane.
600%?
Right? 600% because they went from nobody coming to the theater to a ton of people. So I'm going to go 2, 5, and 8%. Just small numbers. Now for profit margin, I'm going to go back to their stable years when they did $5 billion in profit in 2018. Oh, shoot, they lost money. Oh, my God, they hate making money.
Every year.
Oh, my Lord. Guys, go find a better stock.
Boom.
Just go find a better stock. I mean, let's do the math here. Let's assume, what's their gross margin? The gross margin is 70%. So let's assume they have real estate, all that stuff. Let's assume 8, 12, and 16%. We'll do the same for free cash flow. PE, 13, 15. Actually, you know what? I'm going to go with 12, 14, 16, and same price of free cash flow. Why did I go lower than the historical average of 15? Well, what's the future of theaters? I don't think it's better than it's going to be today.
No, I don't think so.
There very well could. All of a sudden, somebody could wake up tomorrow and go, I have a perfect idea for theaters. And all of a sudden, theaters skyrocket in value. Sure. But your job as an investor is to not bank on the flukes happening. Your job is to sit there and say, what's the more probable outcome? And how can I make money off that? And then finally, desired return. Guys, I'm going to go high here. I'm going to go 15%. I usually do 12.5% when the market does 9 or 10. But the reason I picked 15% is there's a lot of uncertainty here. They're not cash flow positive yet. We got to sit there and assume these numbers, these profit levels. And frankly, when they were making money, they were making like 2% profit. But I just want to show you how crazy it is. Hit the analyze button.
All red, baby.
It's all red. It's not as terrible as I thought it was going to be. But guess what, guys? $15 a share, assuming 8% revenue growth for the next 10 years, and assuming those profit level numbers that they've never seen before. Do you see my point here? They've never seen 16% profit margin. In their 8-9 years of history that we see, they never had 16% profit margin one time. That's the point. Let's go see what their best profit margin was roughly. 4%. 4%. Yeah, it's not 4%. So let's go in here and actually put the real numbers in here. Let's go 2, 3.5, and 5. 2, 3.5, and 5. Analyze button. Here's your stock right here. $1 to $5. It's just math, guys. Now, unless something up here is egregiously wrong, which it very well could be, I don't think it's worth the risk for me to buy it. At 10% return, which is basically what you get for buying the regular stock market, hit the analyze button, you're at $7. If this makes sense to you guys, if this is ringing a bell, please subscribe to the channel. If you hate me dearly, please tell me in the chat. I love it. Comment below how much you hate me. Thank you very much for your time.